This is Nightly Business Report with Bill Griffith and Sue Herrera.
No Santa, no rally. Stocks were quiet heading into the holiday, but as the season of the Santa Claus rally kicks off, what do these trading days mean for investors in the new year? Final push. It's the last-minute shopping rush for the holidays. Which retailers are the big winners this season? And going for growth, tonight's Market Monitor is a known value strategist, but he thinks growth may be a winner in 2020. All that and more tonight on Nightly Business Report for Tuesday, December 24th. And we do bid you a good evening, everybody, and welcome. Sue has the night off. 'Twas the night before Christmas, and all through the street, nary a bad word was found, not even a tweet. Investors all watched the market with care in the hopes that St. Nicholas soon would be there. Alas, there was no rally, but it's all right because compared to last year, calm was a welcome sight. Apologies to Clement Clark Moore, but investors might well have been relieved that there wasn't the same turmoil we saw last Christmas Eve when the Dow fell more than 650 points and the S&P briefly entered bear market territory. Today, in our holiday shortened session, the Dow fell just 36 points. NASDAQ climbed another 7 to close at its 9th straight record. That's the first time that's happened since 1998. And the S&P 500 was off a fraction today. Bob Pisani has more on what a difference a year makes.
This time last year, market was closing on the lows for the year. What made the difference? It was a combination of four factors. The Fed cut rates and added liquidity to the markets. Second, economic data has been strong enough to indicate no recession. Third, hopes for a truce on the tariff and trade wars. And finally, some signs the global economy may be bottoming. One clear trend likely to continue in 2020, the big are getting bigger. S&P's up 28% this year, but the 10 largest stocks are up an average of 40%. Apple's up 77%. Microsoft's up 55%. Only Amazon, up 19%, has underperformed the S&P in the top 5 this year. What's next? Some are arguing the markets are expensive given that earnings have been flat this year. But stocks can historically trade at higher prices relative to their earnings if there's signs the economy is still expanding, and most believe that's indeed going to happen. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So what would a Santa Claus rally, if it comes, bring in these final days of the trading year? Joining us right now, our friend David Sowerby, Portfolio Manager at Ancora Advisors. David, always good to see you. Welcome.
Merry Christmas, Bill.
We've already had a good year, as Bob pointed out. A good December, best December on Wall Street since 2013. What would these last 5 days mean if we continue this rally?
Momentum is still the market's best friend, as you indicated. The 11th best year for the S&P 500 in more than 90 years of S&P 500 history. Let's just put it in perspective. This is Elf on the Shelf meets a Festivus miracle for year-end 2019 with momentum carrying into early 2020 because we're still in that seasonal period where stocks are going to be the investor's best friend and meaningfully outperform the low yields we're getting in the bond market.
But as Bob pointed out, the Fed was cutting rates this past year. They're not expected to do anything in 2020. We were worried about a trade war. There seems to be progress on that now. I mean, all of these headwinds that we're facing the market are falling by the wayside. Can it be that easy that we're going to see a higher market in 2020?
I think so, but you and I have had the conversation before that. In a single calendar year, the stock market almost never returns the sweet spot at 9 to 10%. It's usually better than 13% or less than 6 or 7%. So next year, maybe a little more tepid growth for the stock market. But I think a stock market that still favors where you're going to see active investors do quite well, where there's a rotation into some of the laggards of this year, like energy and healthcare. Right. I think it's still a market that's going to be fairly healthy net of inflation and taxes.
And speaking of laggards, what about the international markets where we were worried, again, another headwind this year, the soft economy overseas, which seems to be bottoming out right now?
Terrific question. I think if I start with a blank piece of paper with $100, I want $80 to $90 in U.S. stocks, the remainder in international but emerging markets. I simply don't see the efficacy or the desire to want to be in developed international markets. That's been the case since 1985. when S&P 500 stocks have compounded better than 4 percentage points per year better than developed international markets, Europe, Japan in particular, because the growth rates simply aren't there to support the growth rates we're seeing here in the United States.
Technology, that's long been the favorite of anybody when you ask them what they like. Is that still the case for you as well?
I think within reason, yes. So tech, we know this year was up better than 45%.
Right.
So, for example, in the mutual fund that I co-manage, on the margin, we still have a good weighting in tech, but we've been on the margin reducing names that have done quite well this year. Apple, Accenture, Microsoft come to mind, and we've been adding to the names that we think have the better potential next year in healthcare, names like Amgen or CVS on the healthcare side. I think that's the reversion that's going to take place in 2020.
David Sowerby with Ancora Advisors. Merry Christmas and Happy New Year's.
Likewise, right back at you, Bill.
Thanks, David. It's the final few hours before Christmas, and the last big shopping push is on, and it could be big. This past Saturday, known in the retail world as Super Saturday, it's estimated that sales reached more than $34 billion. And while the consumer is driving this economy, the way we spend that money is different than we did it 20 years ago. Ilan Mui digs into the numbers for us tonight.
While everyone else is focused on Christmas presents, I'm here to talk about Christmas past. Let's rewind the clock all the way to 1999. How were consumers spending their money when the internet was young and we were facing a brand new millennium? Online shopping barely even registered back then. The National Retail Federation hadn't even begun tracking internet sales. Now, the trade group forecasts they could reach $167 billion this holiday. That would help drive sales this season to another record high.
This holiday season is looking to be our best in years. This past Saturday was the single strongest shopping day of the season. All early indicators are showing that this holiday season has been quite strong.
Can I put it on your CS card?
20 years ago, a bigger portion of our annual budget went toward food and clothes. Food used to eat up 13.6% of our income. Now it's 12.9%. Apparel was once almost 5% of the budget. Now it's 3%. Part of the reason is lower prices and the rise of fast fashion. But it's also the result of rising incomes. A smaller share of the budget now needs to go toward necessities. And there's more good news for consumers on the housing front. While the share of income that we spend on housing has stayed the same, we're paying a lot less in mortgage interest thanks to rate cuts from the Federal Reserve. A 30-year fixed-rate mortgage in 1999 was 7.4%. Today, it's less than half that. So that means we should all have a lot of extra money, right? Not so fast. Take a look at healthcare costs. They've gone up from 5.3% of the budget to 8.1%. Spending on health insurance has more than doubled. Economists say the big culprit is inflation. Healthcare costs have risen by 3.5% over the past 2 decades, while overall inflation has been at just about 2%. But America's aging population means that healthcare will continue to be an issue in 2020 and beyond. For Nightly Business Report, I'm Ilan Mui in Washington.
Let's turn now to Dana Telsey to talk more about the winners and losers this holiday shopping season. She, of course, is CEO and Chief Research Officer at the Telsey Advisory Group. Dana, always good to see you. Thanks for joining us tonight.
Thank you for having me, Bill.
And let me cut to the chase to begin with. The optimists were saying 4% sales growth this year, maybe a little bit more than that. Do you think we hit that this year?
I think we hit that this year. Yes, I do. I think it was a season of the haves and have-nots. Value and convenience really mattered. It worked. And this is the first season where really buy online, pick up in store basically went out to all the different retail chains. It mattered because the attachment sales are incremental.
Yeah, consumers and the retailers have become much more comfortable with this online phenomenon. The brick and mortars know that they've got to be online as well to grow their sales. How much more do they have to be online in future holiday seasons?
I think we're going to continue to see online grow, but it doesn't mean you're not going to see stores be that essential. Every time someone does a buy online, pick up in store purchase, guess what? They're spending an additional 20 to 30% more when they go in and pick up that item because they're buying other things. When you have a physical store, your online sales go up. If you close a physical store, your online sales can go down nearly 50 to 60%. So I think over the next decade, we're going to see the integration of digital and physical even more tethered than it is today.
We keep hearing about the demise of malls, but I then hear that the younger generations like to go to the malls right now. It's become more of a social gathering place for them in addition to a shopping center, right?
It is. I think one of the things is people want to interact. They want to socialize. You want to meet people. You want to be able to have dinner or lunch together. And I think one of the items that we're seeing is everyone wants that acceptance. Why do you see, whether it's a Sephora, whether it's a Lululemon, you're seeing people do activities together. The activity of buying has to be married with the activity of doing, and you can do that in shopping centers. And we're seeing whether it's the Gen X or the millennials, they're all working together to make that happen.
Who are the winners this season, do you think?
I think it's going to be Target, Walmart, Amazon. I think it'll be Lululemon. I think Sephora, Vans. And it's going to be some of the luxury stores like Louis Vuitton. I think the off-pricers like TJX, Ross, and Burlington also win and win big in holiday 2019.
This was a record year for closures of retail stores, more than 9,300 closing. Who's on your watch list for after the season?
I think you're going to see some of those retailers who didn't close all the stores they needed to. I think you're going to potentially see more. Certainly Pier 1, Forever 21 continue to be on the bucket list of what needs to be watched.
Dana Telsey with the Telsey Advisory Group. Happy holidays. Thanks for joining us, as always.
Happy holidays.
Thank you. And with all that shopping being done, let's not forget about deliveries. Well, more than 2 billion packages will have been shipped this holiday season. So how are the UPSs and FedExes of the world handling that last mile to your doorstep? Frank Holland takes a look.
There's more pressure than ever to go from online order to on-time delivery for major shippers. In the last week before Christmas and Hanukkah, UPS delivered the highest percentage of packages on time at 99.8%. Anything above 95% is considered good. The major shippers separated by a few tenths of a percent, but when even a tenth below 100% represents 86,000 packages that were not delivered on time. Sometimes good isn't good enough. However, logistics analyst Satish Jindal from ShipMatrix says he was impressed by the overall performance.
The few people who don't get it, they get to make a lot of noise in social media, but those will be very few compared to the hundreds million people who will be receiving their package in time for Christmas.
For the full holiday rush since Black Friday, UPS is also the leader for on-time deliveries. New data shows the shippers are on pace to deliver 2.5 billion e-commerce packages this season, breaking previous records. Also, they're doing it in the shortest window possible, only 33 days between Black Friday and New Year's Eve.
Next year, we're going to see over 3 billion packages in the same period, and this pace of growth will continue for at least a couple more years. So the carriers need to start thinking about how they're going to handle this in the future years.
Some of that volume will also be returns of gifts and self-gifts, gifts that people bought for themselves during the holiday sales. Returns of online items will increase by $5 billion over last year. For Nightly Business Report, Frank Holland.
Coming up, why tonight's Market Monitor likes growth stocks in the new year. More and more Americans shop for their mortgages online these days, and that's actually helping some underserved borrowers get approval. Diana Olick explains how one company is trying to remove potential bias when it comes to getting a mortgage.
Online lending is fast taking over the mortgage market, with older names like Quicken and LendingTree, as well as upstarts like Better.com. And these online platforms may actually be leveling the playing field for borrowers and reducing bias in the market. Better.com, which reported 350% growth itself last year, also found some interesting numbers regarding its borrowers. A 10-fold increase in married LGBTQ couples, 5 times the number of single women, a 675% jump in Gen Z borrowers, over 500% growth for Hispanics, and just over 400% growth for African Americans. Under the Fair Housing Act, mortgage applicants are not required to disclose their race, gender, or sex, so the online process removes any potential bias, whereas in-person or phone applicants could still face discrimination.
A mortgage broker might judge and say, hey, maybe you shouldn't qualify for this, or you shouldn't buy in a particular neighborhood, or maybe your monthly payment should be this. We're able to express the criteria that all the major investors and the government-sponsored enterprises like Fannie Mae have, and take that judgment out of the process and actually empower the consumer to make their own best decision.
Garg says more than 40% of Better.com's customers use their mobile phones to start the mortgage process. That accessibility is a key driver of the company's growth.
Last year, we were doing $150 million a month of mortgages. This year, we're doing about $700 million a month of mortgages. And by the end of next year, we'll probably be doing about $2 billion a month.
And Better.com's agents do not work on commission, another aspect designed to empower the borrower. For Nightly Business Report, I'm Diana Olick in Washington.
Uber's former CEO and co-founder cuts ties with the company. And that's where we begin tonight's Market Focus. Travis Kalanick said today he will be leaving the ride-hailing company after exiting his board of directors post at the end of the year. Kalanick will now be focusing on his philanthropic pursuits, and he's currently working on an interesting food delivery startup as well. Shares of the company rose a fraction today to $30.44. Spirit Airlines said it's going to be buying 100 Airbus A320 NeoJets to be delivered through 2027. They also have options to purchase 50 additional jets. Carrier says the deal includes a variety of Airbus models. Spirit's current fleet of 140 jets is entirely made up of Airbus. The stock was up a fraction as well today to $41.19. Electrical and industrial products maker Wesco is offering to buy networking equipment maker Anixter for $90 a share. Now, Anixter already received a bid from a private equity firm for $86 a share. Wesco says its proposal would create a leading electrical and data communications distributor. Anixter's shares rose nearly 3% today to $90.03. Wesco rose more than 5% to $58.57. U.S. regulators have fined Credit Suisse's U.S.-based securities unit $6.5 million for supervisory failures. Authorities say that the bank did not properly monitor potential trading violations. Credit Suisse was down a fraction today to $13.22. And RBC Capital has raised its price target on advanced micro devices to $53 a share from $50, citing the chipmaker's growth in its gaming and data center businesses. AMD gained more than 2% to $46.54. Now, all week, we're getting you ready for the new year by bringing back some familiar Market Monitor guests. And tonight's guest is buying some growth names heading into 2020. Last time he was with us in August, he recommended Lowe's, which is up 11% since that time, Nice Systems up 2%, and Yelp, a 4% gainer since that time. We welcome back Richard Steinberg, the Chief Market Strategist at the Colony Group. Rich, always good to see you. Thanks for joining us tonight.
You too, Bill.
And before we get to your stock picks, I want to pursue this. I've always thought of you as a savvy value investor through the years, but it sounds like growth is your strategy for 2020. Is that the case?
I think when we're looking at names that are going into next year, we're finding some mispriced growth names that we would call GARPy, growth at a reasonable price. Mm-hmm. So I think we're finding names, two of which are GARPy, and one is a value name that we think will turn back into a growth name once things work themselves out.
Okay, so you haven't completely given up on value. Let's look at these three companies here. There's Booking Holdings, the old Priceline, and if there's ever a company that needs to split its stock, this is it here. Why do you like this one here?
Yeah, they own Kayak. They also own OpenTable. It's a play on international travel, which is about 50% of sales. The consumer sticking around in what we call alternative accommodations or holiday rentals. We think this business is a really strong business. It's well managed. Over the last 10 years, this company has returned shareholders at 25% annualized CAGR, And we think the stock has another 28% upside to the 25.70-ish level. It's a big price name, but I think it's a name that should be in people's stockings.
Then CVS, we've talked about this one again recently. This is a company, obviously, that wants to be on the vanguard of refiguring the healthcare industry. We're showing you a one-year chart. It's had a pretty good year, but for the last 3 or 4 years, this has gone lower. It's been trending downward. Why do you think this is a growth stock for next year?
Yeah, this is the value, hopefully turn growth. So we think that the Aetna purchase is transformative, and we think that the market has mispriced Amazon's risk into the pharmacy business. The stock, we think, could trade at least to 94. It's trading at 10 times earnings, so it's got a value play on it. And it, as you said, it hasn't had a big move over the years, and this may be the year for CVS next year. So you have mid-20s upside to this name.
All right. Finally, a company I was not familiar with. It's had an interesting business model, John Bean Technologies, in food processing and air transport.
Yeah, think slicers and packaging and loading planes and de-icing planes. Two separate businesses.
Right.
They've been, but think also about ready-to-make foods and food delivery. And that's the business that they make the equipment for. The stock is, we think, cheap based on its future growth. And the food processing business in particular is very fragmented. So they have a strong M&A culture, almost like a mini Danaher. So we think that this is an exciting stock. It could trade into the mid-150s next year, which would have big upside.
Very good. Richard Steinberg with the Colony Group. Happy New Year. Good to see you. Thanks.
Happy New Year. Merry Christmas, Bill. Always great to be on this other side of the camera with you.
Thank you very much, Rich. And coming up, a family dynamic that could make navigating your finances very complex. Finally tonight, the holiday season filled with family gatherings and traditions can be a tense time for some, including those in a so-called blended family. You know, when you marry a partner with children from a previous marriage, your family becomes blended. And as senior personal finance correspondent Sharon Epperson reports, this increasingly common family dynamic can make figuring out money issues especially challenging.
At first glance, Ronnie and Lamar Tyler are a typical modern family. The Tylers own a media company and live outside of Atlanta with their 4 children. The two got married 14 years ago.
It was basically love at first sight for Lamar.
For Ronnie.
What sets them apart? They are part of a growing group of American families defined as blended. A couple that joins together with the children from one or both of their previous relationships creates a blended family. Ronnie already had 2 children before meeting Lamar. The couple had the youngest 2 after they married.
Being in a blended family, it kind of blindsided me, and I wasn't really intentional about trying to figure out, like, what does this mean for me? What does it mean for my husband? What does it mean for my kids?
Navigating the complexities of a blended family can be difficult enough. So couples often put off having the money talk, a critical piece of the blended family puzzle.
So one of the first things we said we had to do was go out and get someone that was more educated, that knows more about these things than us, that can advise us on, what are the proper steps to take and also what are the steps not to take.
Marriage and family therapist and author Ron Deal has counseled blended families for over 2 decades. He says understanding the role money plays in combining 2 families is crucial.
As you move forward as a family, you can't address everything, you just got to get started. One of the things we recommend is that couples create what's called a togetherness agreement. And that's a detailed plan of how they are going to care for one another in their marriage and in their family, care for one another's children.
The Tylers often work together from their home office, juggling work and family. On this point, they never waver. They're both all in for all of their children financially.
How did you come up with your decisions about finances for your children?
Financially and everything else, I treat the children just as they were my own. And I'll, give them money, we'll pay for things as if they were my own. Sometimes I'll refuse to give them money as if they were my own.
Lori Marshall is the author of the book, The Stepmoms Club. She wrote the book as a guide to empower stepmoms who, like herself, were struggling to navigate the nuances of a blended family.
What are your financial obligations to your ex? Child support? Is there alimony? Are you responsible for paying for housing? Having that conversation, asking those questions immediately. How hard is that?
For their part, the Tylers say they work through financial questions by following one simple rule.
The more that you can communicate, the more that you can show that united front, even from a financial perspective, the better off you'll be as a couple.
And when the money talk gets tough, the Tylers say, ask an expert for help. For Nightly Business Report, I'm Sharon Epperson.
And before we go, a final look at this shortened day on Wall Street because of the holiday. The Dow fell just 36 points. NASDAQ climbed 7 to close at its 9th straight record. First time that's happened since 1998. And the S&P was off a fraction today. That is Nightly Business Report for tonight. I'm Bill Griffith. Thank you so much for watching. Have a great evening. We will see you tomorrow with a special holiday edition of NBR. Good night.